So about options. So once you're doing an individual stock, like let's say Tesla, Tesla is the stock that we'll focus with today. It's one of the ones I do like to trade on. So once you pick an individual stock, you can buy the stock, of course, and if you buy the stock and you put down $100, and the stock goes up 10%, you're going to make $110. If it goes down 10%, you're going to have $90. So that's the only math you need to know to buy stocks. Stock up 10%, you make 10%. Stock down 10%, you lose 10%. With a little exception there that you want to be aware that a good practice is to change the way you think about your losses and to overemphasize a loss, which is to say, if a stock goes down 50%, then from $100 it goes down to $50. If it goes up 50%, then from $100 it goes to $150. But you want to think when you have a loss of 50%, you want to think about it as 100% loss, which is to say that in order to get your $100 back, once you have 50, you now need 100% gain to get back up to 100. So if you learn to phrase your losses in terms of negative, like I think of them as negative gains, like a 75% loss, which is $25 of 100. You want to think about that as a 400% loss, or whatever, 300%, because you need a 400% gain or whatever, 300% gain, I guess, to recover your money. So yeah, 300% loss, that's fine. So if you think about it goes from 100 to 25, you now have a 300% loss rather than 75% loss. And part of the reason you do that is now a 300% gain will offset the 300% loss. And now you're speaking apples to apples. That's how you want to think and buy things whenever you're thinking gains and losses. So back to call options. So with call options here, or options, puts and calls. So if you buy a call option, you're saying that the stock will go up, and if it doesn't go above your strike, or if it doesn't go beyond a price you set it at, then your options are totally worthless and you get $0. So you have 100% loss in that situation. Now, why would you do it? And the reason that you do it is because you get more profit if it goes up. So for example, if you bought Tesla call options when the price was, I'm going to just say the $300 or whatever. If you bought Tesla call options when the price was, and I just, for now I'm referring to what I'll call a naked call option, just plain simple call option. This is never, ever, ever how I'll recommend, for the most part, this is never, ever how I'll recommend you engage in stock trading. I'm just talking about it because this is how people learn about it. This is the way I'll show you to do it here in just a second is going to make you so much more money, so much faster than this. But just to have an overall view of things. So a Tesla call. So if you bought call options when Tesla was $300, you could have invested, let's say $3,000 or whatever at the call options that would have expired maybe 2 years into the future. And then when Tesla went up to $1,500 as it did from that period of time before the split, when Tesla went up to $1,500, instead of getting 500% return or 5xing your money, you could have easily got 20x Some people invested like $25,000 in the call options, ended up with $1 million. So so that's why you would do a call option. Now, how does the math work on a call option? And the math, to keep the math simple, and roughly what we'll be looking at here in a minute, if the stock is $300 and you buy a call option at $320, strike, they call that a strike. So the stock is currently trading at 300. Your claim is that it'll go to $320, and then you have to pay something for that privilege to buy the stock at 320. And let's say you pay $1, and then they multiply all this by 100. So every stock option is always 100 shares. So if it's a $300 stock, you claim it'll go to 320. You pay $1 for this, so your break even is now 321. 321 is your break even. And then you can easily say, well, when do I double my money on that call option? And it's 322, because you paid $1 and it has to go $1 more than what you paid, and now you've doubled your money. So if it goes to 322, you've doubled your money. And then you can kind of do some backwards math to say, okay, 300 if you bought the stock, 300 going to 322 is what, a 10% gain. And then with the call option, you made 100% in this, fictional scenario. Now then, if it went to 315, your call option is worthless and you lose 100%. So even though the stock went up, your call option expired worthless. So that's basically the call option math, and a put option is the reverse. So a put option says that you believe the stock will go down. So it's $300 now. You buy a put for $280. You pay $1. It has to go to $279 to break even. And if it goes to $278, then you doubled your money. If it goes to $270, then you made 1,000% return or whatever, 10x your money. So that's the, basic. I'm going to round all my math. I'm going to speak in mental math, not Excel calculated math. So that way I won't get the little nerd people being like, oh, your numbers are off. But that's the basic math of it, right? If it's 280, you pay $1, it goes to 270. You made $10 on $1, 1,000%. So fantastic returns in this fictionalized world. So that's with puts and call options. Puts saying that it'll go down, or shorting. A lot of people will say shorting. I'm gonna misuse a lot of lingo here because I think it's easier to say it. If you ever look into options lingo, it gets totally ludicrous in terms of how many strangle, iron condor, emerald lizard. They get pretty crazy with their terminology. I'm going to use mostly terminology that I think makes sense for me, but some of it will be accurate. So a put is shorting the stock. A call is longing the stock. Buying stocks are buying stock is by default long stock, and then there's other things that are like a naked short, so when I say I said a naked call before, like a covered call is well, that's more on selling calls, but anyways, I'm going to use naked in terms of not using a spread, and spreads are where you'll be making most of your money. But I'll get into that later, so I'll just try to take it one at a time. So yep, that's call options, put options. I think I covered that quite well, and they all have an expiration date. Whenever you see people talking about it, they'll usually be trading on options that expire a week, a month from now. And the reason they do this is because these things cost like $1, they cost a few pennies. And if you buy options that expire like multiple years from now, then they might cost quite a bit more. But the predictability is, in my opinion, a lot higher, and the return is definitely worth it. So even though I will show you how to do a short-term option that might make you some money, most of the options I like to do are long-term because they make predictable money, or at least that's my view of it, that they make predictably more money. So, so yeah. Now market volatility, I already, okay, so that covers, yeah, market volatility. So with options, you're betting on it going up or down, and you make money from both. So if you buy Tesla stock today because you believe in Tesla stock, then you only make money as a percent of whatever it goes up. And you pretty much know that it can't go up more than about 100%. That's your maximum gain. When you do options, you get, a factor of percentages. So if Tesla goes up to 100%, you might get 1,000% with options. If Tesla stays flat, you might be able to get 100% gain with your options trading. Options is all about market volatility, or the degree of up and down, not whether or not you think it will go up. That's pretty irrelevant. So okay, so that covers the intro of the options and a little bit of market volatility. So if you like that, check out my Patreon, Bitcoin 1776. We're going to be mining for coins and doing giveaways for social groups for coins. So feel free to join the little newsletter and check it out, and like and subscribe, etc. Thank you. Okay, so now let's get into the meat of the matter, which is spreads.